Good morning. It's Monday, September 14th, and I wanted to give a quick market update from Pathfinder. We had a return to volatility the last couple weeks and a sell-off in the market, at one point reaching 7%. This has been concentrated mostly in the highest performing stocks, the big US tech firms, and those high growth companies associated with those trends. Sell-off is hitting the headlines because it is those big tech names that have driven the market up 55% since the market bottom in March. And a 7% sell-off is really not that uncommon. We've had 20 corrections of 7% since 2009, meaning that we get these almost 2 times per year. This one is concentrated really in those high-performing stocks, and many of those same companies after a 7% sell-off are still higher than they were a month ago in August. From our perspective, this seems to be just normalized profit taking and nothing fundamental, nothing that's changing the way we are seeing the overall economy improve, and that's been going on since really the spring. Speaking of the economy, late last week we got in some final August data, and we have seen another increase month over month in our economic dashboard. July was an improvement over June, and in August 2 more economic indicators turned from neutral to positive. These include a narrowing of credit spreads, increasing the demand for fixed income investments, which basically ensures companies access to capital, publicly traded companies, so they can keep their business running smoothly. The second trend was the uptick in housing starts, and that signifies a healthy housing market, which in turn has a strong multiplier effect because of the complementary spending. It can be tough to see this kind of economic recovery. In April, I said the jury was still out whether we would call for a V-shaped or a U-shaped recovery. I'd also mentioned back then that COVID is affecting everyone, but it's affecting everyone differently. I mentioned that low-wage workers would be hit the worst, such as restaurants, travel, salons, retail, entertainment, all kinds of service-related businesses. And now I'll throw out a term that's gaining popularity, which is that we're probably in a K-shaped recovery. And so what a K-shaped recovery is, if you think about the K, the upward portion refers to the knowledge-based workforce who were able to minimize the contact during COVID. So, these folks were able to move remotely. They were already in offices where they didn't have a lot of public contact. And most of these people are on salaries. These folks actually benefited financially from COVID because they had a sharp reduction in their normal costs. No more commuting, no more going out to dinners, no more weekend getaways, salon trips, impulse shopping. So when you look at the stats, it's kind of staggering, but the savings rates trended between 7 and 8% from 2015 to 2019. So again, 7 to 8% savings rate in America. And in March, they spiked to 13%. They escalated to 33.7% in April with the world shut down. And then, of course, it's turned, but July was our latest data, and it's still at 17.8% savings rate. So what did those people do? Well, they were able to refinance their mortgage rates because their interest rates dropped low. They were able to pay off debt. So now they have increased income. They were able to refinance loans if they needed to. They were able to increase their 401k contributions. And so that part of the economy, those folks are actually financially healthy, and probably more so than we've seen in many, many years. Unfortunately, that reduction in spending was a lifeline for the hotel staff, waiters, cooks, personal trainers, flight attendants. So the government stepped in with stimulus checks and unemployment, and that put a lifeline out there. But those folks are still the ones that are not fully back to work, and therefore the downward portion of the K recovery is directly impacting our lower wage workers in America. So, that's what's going on. So a K-shaped recovery is kind of a new term. Good news is that we have these consumers with more discretionary income in a better financial condition than they've been in. And the slow improvement in the overall economy is evidence there with the not only the housing starts and the credit spreads, but also we're starting to see continued improvement in the unemployment situation with increased employment in those service sectors. So travel's picking up, restaurants are being innovative, low-wage workers are finding new jobs. In distribution centers and grocery stores, grocery stores now have pickers versus just cashiers and bag boys. So pickers are in high demand. Sanitation has a new term from when I was growing up. So there's workers that are just going around sanitizing public spaces. And of course, distribution is king right now because everybody's selling everything virtually. So even a company like Amazon is hiring another 100,000 people across America. So, overall the economy is improving. I'd be remiss not to mention politics, as that seems to be front and center for many folks. Unfortunately, too much time at home also means too much exposure to media. That's never really a good thing for stress, and certainly not a good thing for decision making. We'll be putting a video together later this month, specifically addressing the upcoming election and how it may impact the markets and the economy. For now, though, the recent increase in volatility and the big tech name sell-off is likely nothing more than just short-term profit-taking, and that the underlying conditions from the economy are still improving. COVID is still the center of attention, and better treatments and vaccination are going to be a catalyst for further improvement, and we'll have to wait to see how that unfolds. I don't envision a return to normal because normal is going to be different. We're going to have a modified new normal going forward. Some companies are embracing this paradigm shift, innovating, adapting to technology changes, improving their productivity in new ways, and contacting and delivering to customers more efficiently. So the companies that fail to adapt will fail to win in the future, and those that do adapt and innovate will come out ahead. And this is why we're investors, and this is normal. This is normal economic and business atmosphere. I mean, this is what we want. So change is a catalyst. Forced change is this catalyst that's going to show us which companies are better positioned for the future, and that makes us better investors. In summary, investing is a marathon, not a sprint. We say that a lot, and it's really hard to see past the election or past the short-term volatility, much less focusing on 3 to 5 years. But you also need to focus on the time that you do have and focus on the things you can do and not worry about these things that are out of your hands. After all, 1 year ago, there was not a novel coronavirus in existence. So thanks for being Pathfinder clients. Just a quick market update. Our team stands ready to help you any way we can, so give us a call. Have a great week. Thank you.